Welcome to a video that I call the deep dive video. And I want to explain this if you're the first time watching this video and you clicked onto it to think we're going to go real deep into certain charts. This has a bit of a different context. Every week I do a number of different videos and I pick out those charts that are really speaking to us right now in those videos that I post. Well, this video is to look at the charts that sometimes we look at, sometimes we don't. There's also some charts that are unique just to this video because we have to look deeper into these charts in this video to see, are they really telling us something? Are we getting some insight from this? This is being prepared for Monday, September 23rd. I do have a thing called the SPX investing program. It's up, it's running. There's a link below this video to take you to the website, or you can watch a video about the program. You can send me an email if you have any questions. And there's additional videos that I post there, additional things that I do. I have courses that I'll be rolling out there. I have a course there now. I also anticipate doing a live version of the basic course sometime in late October. The daily video is the real foundation of what I do. This is the deep dive video, and I do a number of weekly videos that tie into the daily video. So if you just watch this video, you're probably not getting all of the context of my analysis and commentary. And if you find that useful, please feel free to check out some of the other videos. The first area that we look at is the VIX. This is more for information. We look at the range of the VIX over a long period of time. And what we do is use a 50-period exponential moving average to do that. Even though we've been going up recently, for the most part, we've dropped down into a lower range since the stock market has been bouncing up in late 2022. We also want to know the speed of the VIX. Now, sometimes I'll show this chart in the videos if we get an extreme positive or negative reading. We're not getting that now, so I haven't been showing this chart. Then we do a ratio of the VIX to an indicator of the VIX called the VVIX, or volatility of the VIX. And as a general rule, when this is going down, that's positive. When it's going up, that's negative. Well, we've been just more or less chopping along sideways right now. Then we do a correlation between the VIX and the S&P. Sometimes when this gets very high readings, you can see what the market did after that. A lot of times it marked a top, sometimes it just marked a continuation, but we're getting a very low reading right now, so there's been no need to show this chart. Then we look at the volatility of stocks as measured by the VIX, and the volatility of bonds as measured by the MOVE index, and we can see that we're above the moving average. And generally, as this is going up, sometimes the market is going up. When this is going down, sometimes the market's going down. We're above this now, as both bonds and stocks have been going up, and with the S&P setting a new all-time high this past week. Then where are we in relation to the previous all-time high that was set early in January 2022? As of Friday's close, we are up 18.34% from the previous all-time high. Then stockcharts.com has this thing called technical alerts. They are triggered. I go through the daily ones each day, but what you see here are the alerts for the whole week. Typically, just by looking at the colors here, if we're blue or green, that's positive. If we're red, that's negative. So if you want more of a breakdown, and I don't spend a lot of time going through these in the daily videos, but if you want to see more of them on a day in and day out basis, the daily video is the place to go for that. Then stockcharts.com also has another tool where you can take a stock or a sector or an index, which is what I do, and rank them on a score of 0 to 100. The higher the score, the better looking on a technical basis from what I show is that index. And I have 5 indexes that I show. The S&P, because that's the foundation of everything that I do, the Dow, the NASDAQ 100, the mid caps, and the small caps. So then we can rank them on a scale. Coming in first place is the SPY at 82.6. Now, when a chart is really strong, it gets up into the 90s. But this is looking better. Why aren't the QQQs on here? Well, because the SPY is more broad-based. It's a bigger index. It has 503 stocks in it, where the NASDAQ 100 is all tech. And when tech is really in favor and going higher, yeah, the QQQs lead things higher. But we're seeing the rest of the S&P 500 performing better, and not just the mega caps right now. Then in second place are the small caps, believe it or not. they've been one of the weaker areas at periods of time. You can see kind of on a historical basis, not so long ago, we were down under 30. Now, we'll look at the chart later in some other videos, but we really haven't broken out of a range. And when you compare the small caps to the S&P, the small caps are still really underperforming, but they're coming in this week with a score of 75.5. The Dow, which set an all-time high on Friday, is coming in third place at 75.3. Here's the QQQs coming in fourth place at 68.5. We're seeing some weakness. In fact, if you look at some of the other videos, you'll notice that the NASDAQ has been outperforming the NASDAQ 100 really for the last few weeks, maybe possibly even few months. Then in last place are the mid caps at 51.2. They did better earlier in the year. Now they're just doing okay. They should also benefit from this cut in interest rates, but it can take some time for the small caps and mid caps to enjoy that, because even though the Fed cut rates this past week, it can take some time to work its way through the system. Now, we have a short-term rainbow here going from 10 periods up to 50 periods. Every once in a while, I'll show this in other videos. But right now, this is just showing that this short-term trend is very positive. We have a rainbow going here, and price is above all the lines in the rainbow, and the lines are still going up. Intermediate term, another rainbow going from 50 periods to 100 periods. Also, the lines are going up and price is above the lines. The intermediate term trend is still positive. We look at the 50-period moving average. Now, I usually focus on that pretty much in every daily video, but we're battling with the 20-period moving average now. So I drop this out of the daily videos unless we see some kind of a decline. Then I'll start to watch that. And the same thing is true with the 100 period. We almost came down to this back in early September here when we were seeing some weakness we almost came down to the 100 period moving average before we started to bounce back up. If we start to fall, we'll be bringing out this chart and I'll be showing it in the daily videos. Then the mass index. This triggered a signal back in August. It really took a couple of weeks because we were going sideways as the signal was actually triggering. And then it suggested there would be a reversal, and that's what happened. We ended up going down. But right now, we're not seeing a signal. The Pring bottom fisher is not generating a signal right now, so there's been no need to show this. And then this just shows where are we in relation to the 200-day simple moving average. Right now, we're 9.67% above the 200-day moving average. When we get concerned is when we get up close to that 15% area. Now, we don't know if the S&P is going to go up right now or not. We're coming into some potentially negative things that we're not seeing in the charts, but are in the background. There's a confirmed thing called a Hindenburg-Ullman, and I talk about that in other videos. And we also have, at least historically, some very weak seasonality coming into the picture. And it's already tried to start, but we've kind of been able to push that back, especially since options expired on Friday. That's when things can really start to turn negative in the upcoming week. Now, we don't know. Price may buck that trend and continue to go higher, but we at least want to be aware of these negative things lurking in the background. We're not declaring anything. We're not saying the end of the stock market is here. We wait for confirmation to actually appear in the charts that we follow without making these wild predictions based on pretty much nothing. Okay, now, how are we since the low that we set back in 2023 to where we closed on Friday? We are up 28.99%. I think that's what that says. So a nice big run, up almost 30% from the low. I remember back in here, I was getting notes and emails. Everyone was telling me that the market was going to keep going down, down, down. The charts I was looking at were saying, yeah, not necessarily. And then we were able to bounce up off of that. We've had some rough patches along the way. And then you notice when we hit the top in July, and then we really started coming down, that was almost 10%. And that's when the smart money came in and started buying. If we do start to decline from the all-time high, I'm going to be watching that to see if we go down 10%, and then we'll see if buying ends up coming in. Now, we don't even know if that's going to happen, but those are just the things I'm thinking about looking at going forward from here. Then we have another momentum oscillator called the Connors RSI. This gyrates all over the place on a day in and day out basis. I only look at this when it gets extreme positive or negative, and usually that's confirmed with other oscillators that are looking extreme positive or negative. Then we have some anchored moving averages here. We're above all of them, so there's been no reason to show this. And we use a thing called the percent B indicator. This is when we close above or below the upper or lower Bollinger Band. We got close, but not quite there. We had that big up day on Thursday, and we didn't close above that. So there's been no need to show this chart. And we just want to keep an eye on the S&P 100 on the bottom compared to the S&P 500 on top. Now, lately, the S&P 500 has been outperforming the 100, but it was the 100 that really brought us higher. Now we're seeing a bit of a shift. And so that's why we're watching different areas of the market. Then we have another long-term rainbow going from 50 periods up to 250 periods. The long-term trend is still comfortably positive for right now. We look at a long-term oscillator called the special K. We're above the moving average, and the moving average is going up, so this is positive. Then we look at a weekly chart of the S&P on top and the German DAX weekly chart in the middle, and there's really not a strong correlation between the two right now. We're almost drifting down into neutral territory between the two. Sometimes when they have a high correlation, we can see that what's happening in Europe is also happening in the US, whether it's up or down. And then this is an indicator that I used it for a long time ago for an actual trading system, but this is a 20-period simple moving average of the open, high, low, and close. This creates its own mini rainbow here. This helps determine the short-term trend. When we're coming down, sometimes one of these areas may provide support. When we're going up, one of these areas may provide resistance. Right now, we're above the rainbow, and the rainbow is going up, so we're positive. If we start to fall, then I'll be watching this chart more closely. Then, because we set a new all-time high on Thursday, I've redrawn the fib retracement levels, and I noticed something interesting here, but we can't know this ahead of time. When we really dove down on August 5th, you notice from the all-time high here, this was the 38.2% retracement level. That's kind of interesting, but we don't know this beforehand because you have to draw this kind of backwards. But does this mean something? We've gone up 38.2% from this, back up to a full retracement level, I should say. Does that mean we put in a top, or are we going to be able to go back and set a new high after this? We don't know. It's just a pure speculative question right now. And we look at the broad market where the VIX is for the S&P 500. The Vixen is for the NASDAQ 100. I don't use the top part because of all these crazy lines on here, but we are declining a little bit as far as volatility of the NASDAQ 100. And then we look at a ratio between the QQQs, the NASDAQ 100, and the Dow, and we compare that with the S&P on top, and we see there's kind of a strong correlation between them. And the transports, which have been a disappointment in 2024, that's the red line here, where the Dow itself is just setting an all-time high as of Friday. The bank ETF, we want to keep an eye on this because things were looking really good back in late 2007. And then we went into the great financial crisis. Well, right now, the bank sector and the financial sector are looking good. We just want to keep an eye on this. And then we look at another ratio between regional banks. These are smaller banks and the financial sector itself. Seeing a little bit of an improvement here with a golden cross recently with this ratio. And then these are for information. This is very long-term, 250 period rate of change. We're going up on this chart. We're also going up on this chart. But you notice how we're coming up to this blue line here, and we hit that blue line before and pulled back. There's been other times when this blue line did mark at least that we're near some kind of a top longer term. We could still go higher than this, but we just want to be aware of this while we see it. Then we keep an eye on bonds. This is a ratio between Treasury inflation protected securities. These tend to outperform when inflation and interest rates are going up. They underperform when interest rates and especially inflation are coming down. And we're just chopping around right now. I haven't been showing this chart because the moves are not all that pronounced. We're just kind of going around here as we're wondering, is the market starting to change its personality from wanting this ratio to go down, which means stocks will go up. Now this is going up as stocks are going up. So we're keeping an eye on that to see if there's a general shift going on here. Then we look at the long-term bond ETF, that's in blue, and the S&P 500, which is in red. And we can see on a short-term basis, they're having a slight tendency, I'm sorry, long-term basis, a slight tendency to go in the same direction, where they're actually seeing this short-term relation wear off quite a bit right now. And you can see that from the chart, where the long-term bond ETFs have been going down as the S&P's been going up. And then we look at the QQQs to the long-term bond ETF. Also, this is pretty much back to neutral right now. And this is a weekly chart. Sorry, it's a weekly chart taking the US 10-year yield and subtracting the German 10-year yield. And believe it or not, we can plot the US dollar down here, the index, and there's a pretty high correlation between this. This just shows us the interplay between interest rates and currencies here. And so this has been going down as the dollar index has been going down. If one of them starts to turn up, because the correlation is high, we'll watch to see if the other one starts to turn up as well, either interest rates or the dollar index. Then this is similar chart to what I showed before, tips the 3 to 7 year bonds, so I won't go through that again. And then we keep an eye on the 2-year yield. Now this is really starting to drop here. So we want to know the context. Why are interest rates going down? Why did the Fed cut 50 basis points instead of 25? Is there some kind of a concern, or do they just want to make the market happy? Well, we generally like the idea that interest rates are coming down for stocks, but you have to know the context. Are they lowering interest rates because things are looking weaker economically? And then I have a thing called the possible positive scenarios. I use some of the charts in every daily video, but here, these are the charts that I don't use. These are the percent of stocks above their 200-day moving average inside of the S&P. I use this like an oscillator to get an extreme positive or negative reading. We're not getting that now, but we are above 50, so that's positive. And then we do that same thing. The stocks above their 50-day moving average, an oscillator, not getting an extreme reading, but above 50. And then we look at the mid caps, not extreme, but above 50. And the small caps, not extreme, but above 50 here. So thank you. I hope you found this helpful. Please have a very good weekend, and I will talk to you in the next video.